So to start with, one of the reasons we wanted to have this webinar on this topic was because there's been a lot of renewed interest in gold and silver as a theme over the last couple of months. And this has actually coincided with some stellar performance in terms of how these two metals have really been shining. And a lot of investors are now taking note of how gold and silver can actually be very defensive plays. They're looking at certain data points which suggests a longer term thesis in terms of how precious metals as a basket could perform. So the question that is then on our minds is it time for precious metals to shine, or are they actually lacking luster? What should an investor in today's market really be looking at? And we'll take you through certain data points, and we'll take you through certain sort of things that we're looking at, which would help you identify what you want to do with your asset allocation. So as background, we run a multi-asset product called Sphere, and we also have a mutual fund distribution service where we run a program called Milestones to Wealth, where we work with investors to help them build multi-asset portfolios and be able to participate in different asset classes through the market cycle. So with that, let's get on. So let's first take a look at performance, because I think this is a great indicator of, where this interest in gold and silver is coming from. So the first table is essentially data that we have collated by looking at the dollar price of gold, say from 2021 till today, year to date. The second chart is something that was published by ICICI, and where they have actually taken the rupee return of gold over the last 10 years. So if you look at the 10-year return, it's been about 15%. And I think on the 5-year return, the dollar as well as the INR price return has been more or less the same, right? But what we need to understand is how that 5-year cycle has actually been split up, because there's a common misconception that gold and silver can't really lose value. And if you really look at 2021 returns, right, gold returns were actually negative. Gold lost almost 3.5 to 4% in terms of value. Silver was even more volatile, where you lost 12% in value. In any bull market, and I'm saying even if you take a decadal view on precious metals, you can have intervening years where returns are steep negative, in the sense you lose 10, 15, even 20% on precious metals. So this is something a lot of investors are not really aware of, because there is a perception that no matter what happens, gold prices will eventually move up. And I'll show you a little bit later in the presentation some data points where you can have 4 or 5 years of flat returns in gold, right? So this basically brings us to an important point, which is that the price at which you buy gold actually matters a lot more than just buying the asset at any point in time. Does it have performance potential? Yes. If we look at the average 5-year or the 10-year return, it has been in the 13 to 15% range, right? So then clearly when we look at, say, a year where you have 27 or 35% returns, then those are outlier years. Silver is a lot more volatile than gold, which means an investor needs to be doubly careful about how they're pacing their investments in that particular asset class. So how do you actually value something like a precious metal? Because it's not like a stock or a bond where you're getting a cash flow or there's like a terminal value or something that you can assume, right? So when you have this challenge, there is a need to sort of think about this asset class in a very different manner. So we have a nice framework that we like to apply in terms of, let's see, what are the demand drivers? Is there any thing that is pushing up demand for the precious metals? What are the supply sources, right? So where do we get these metals from? How do monetary conditions actually appear today? Because I think in today's context, there's a lot of talk about how monetary systems have evolved, why there is a need to go back to something like the gold standard, and so on and so forth. You're also hearing a lot about how inflation is getting out of control. how money has been printed consistently, whereas gold can only be managed within a certain volume. After all, you can't arbitrarily print gold, right? What are the use cases for these metals? And then we would, of course, look at geopolitics, because that is, again, something that has been dominating headlines over the last 4 to 5 years. So let's begin by sort of understanding gold as an asset class, right? So if we look at the demand drivers, the first is in terms of, I'm going to break this down into 3 parts. So you have central banks, then you have retail investors, and you have monetary policy. So these would be the 3 key demand drivers in our framework that we're going to study today. So when we look at central banks per se, you do see that historically the amount of allocation towards gold has changed significantly. So this data is from OMFIF, which is basically an organization that looks at monetary policy, financial conditions across the world. So if we see, like if we rewind all the way back to the 1800s, right? Gold was the biggest asset class in the US treasury holdings. And that actually kept going up almost until the 1940s. Essentially, this was your pre-war sort of situation where you kept building gold reserves. And then in the 1960s, and you can see the decadal shift between 1960 to 1980, because that was the era in which the gold standard was abolished, right? And 1940s to 60s, you essentially had your Bretton Woods agreement that came in, where you had the dollar's value pegged against your gold value. So if you see this over the last more than 100 years, you've actually seen gold reserves at a national level decline in most countries. China has been the only exception who has actually shored up on gold. And I think even today, China Central Bank is one of the top buyers or sources of demand, right? So there has been a historical shift that has moved away from gold. And today you are at a point where central banks are again reverting back to gold as an option to hold assets. But let's also look at what the supply and demand statistics are like. And if we look at when the shoring really started on, you can see that Q1 2022 was a big trigger point. And if we trace back to what happened at that point, you essentially had the Russia-Ukraine war break out. And then the US government froze Russian dollar denominated assets and said that you can't use this anymore. So that was actually a key trigger point in terms of bringing attention towards gold as an asset class, because till then it was assumed that the dollar could be freely used. And this was a move where a lot of other countries who felt that maybe they don't have such a great relationship with the US, or that the US may be very arbitrary in sort of freezing their assets, they felt that there was a need to have some assets outside of dollar dependence. And so that gave rise to a lot of bilateral trade negotiations that were going on. It also caused central banks to start looking at assets that are not treasury based, right? So you can see there was suddenly a spike in purchase of gold, and that has been consistent, right? So you've seen larger and larger gold purchases, and if you aggregate them, this is actually a peak. Like if you look at towards say end of 2022, you had a peak volume in terms of how many tons of almost 450 tons of gold that was being bought by central banks. And in this gold buying phase, you did not really see any price movement. So if you look at the orange line and not the bar lines, you can see that gold prices kind of remained stable during this phase. In fact, they actually dipped a little bit, and then you've started seeing the price rise. So now today, as the price is rising, I think what we need to pay attention to is how much demand is actually coming up. And when you see this, there's been a significant tapering in terms of the demand numbers. right? So this again is something for us to think about in terms of, okay, if we are looking at central banks purchasing gold, are they purchasing as much as before? And is there a lag between, say, a price change versus a demand change? Those are things that we need to study and sort of make decisions around. So the next demand driver that we were going to look at is in terms of the monthly gold ETF flows. And here, if you see what's going on, and I think this is where a lot of retail investors are also getting in, because there has been a sudden increase in the number of retail investors participating through gold ETFs, and that's grabbing a lot of headlines. And if you look at this chart, you'll also notice that the dominance in the past has predominantly been North Americans, which are classified by the dark blue. And then to some extent, in certain phases, Europe, especially around 2022. But now, if you look at the chart, you're actually seeing more participation from Asia, right? So this again tells us that there is more demand that's coming in from the retail side. So there have been a lot of questions as to how do gold ETFs function, and in India they are actually backed by physical gold. It's not a digital gold structure, or it's not gold derivative contracts that you can have. So there is actually underlying physical gold behind any ETF or mutual fund unit that you own. Mutual funds tend to buy the ETF units, and ETF units are backed by physical gold, right? So that's the broad logic. It's not based on the price movement of gold. So in foreign markets, you do have paper gold, which is essentially derivative contracts or something to that nature, where there is no physical gold backing that particular financial instrument. So now we'll move on to monetary conditions. And I think this again is from OMFIF. And I do think it's an interesting chart because it tells us a little bit about the history of money as well as the history of gold. And what we're going to really look at is that you had maybe 7 ages of gold's era, and today we are entering the 8th age. So back in the 1800s, you were in the pre-gold standard era, so you didn't really have a gold standard per se. You had maybe promissory notes, or there was nothing really fixed about how you generated money. Then you entered into the gold standard era, where gold was a substitute for money, and then you entered into your war economy, right? Which is essentially, you had the First World War in 1914, and then you had World War II ending in around 1944. So in the war economy, you really did need reserves. And we saw that earlier chart as well, how the US had showed up on gold reserves, and that made them one of the strongest economies during that phase. And post that, it became necessary to have something outside of gold that you could exchange. So then you had the Bretton Woods Agreement, where you said that you would have exchange rates fixed to the price of gold, right? So then you could trade dollars for gold directly at any US bank. And this system worked for a couple of decades. But eventually what happened is that there was a lot of pressure for the US to hold gold reserves. And that led to the abolishment of the Bretton Woods Agreement. And then you had your demonetization era, or your era of fiat currency. So the dollar value was no longer pegged to the value of gold. And this allowed, say, the Fed, as well as essentially the Fed, to print as many dollars as they wanted, right? So then you had your era of stagflation. Then you had, your fiat currency era, and then you had, so this led to a lot of bubbles and crises, right? So you had the dot-com bubble, then you had the global financial crisis, and every time the US economy went through a financial crisis, the priority was to avoid the kind of depression that they had in the 1920s, and ensure that the US economy had enough funding to move forward. So when you do this, you actually expand the Fed's balance sheet. And we have now reached a point where it's not possible for the Federal Reserve to really keep printing money anymore. They need to service and extinguish their old debt before they can sort of widen their fiscal balance. And this has not just happened on the fiscal side. You've also seen it materialize in terms of trade deficits, etc., etc. But essentially, economic activity can allow you to make debt more productive. So the use of debt is the most important element. So in today's era, which I would think is the eighth era, let's talk about it, say post 2021, 22, you are seeing a very different approach to gold. So central banks have started reverting to having gold as one of their assets. We are in an inflationary era as well. Maybe we are not experiencing it in India at the moment, but globally there is a higher level of inflation for advanced economies. So, for example, we are heading into a week where the US Federal Reserve is likely to cut interest rates when inflation is at 2.9%. So this hasn't happened in decades together. So what we need to understand is that this system is very different from what we had in the past. This, I would encourage anyone who's really interested in this topic to sort of go back this weekend and read this piece from Zoltan Pozar, where he talks about the 4 pieces of money. So you can view money as 4 different elements. So you can view money as par, which essentially means that, it's cash, right? So whatever money says on the face value, that's what money is. And this par could sort of refer to different types of the same kind of money. So money in your savings bank accounts, money in your fixed deposits, money in, let's say, a mutual fund, like a liquid mutual fund, should always trade at a 1-to-1 ratio. Meaning, if I have 100 rupees in my savings bank account, 100 rupees in my FD, or 100 rupees in a liquid mutual fund, they all value back to 100 rupees, right? It's not that I'm paying a little bit extra here or extra there. Then you have interest rates, which we need to think about as the future price of money. It's not what money costs today. It's what it costs to take in money for the next, say, 5 years or 10 years or 1 year, depending on how long you're borrowing that money for. And then we look at foreign exchange rates, which is basically the price of money in another geography or another currency. So then you start looking at ratios, right? So you're trying to see whether one type of money will move up or down against another type of money. And lastly, you have price levels, and price levels essentially are, I think a simple way to measure it would be your inflation, because you're looking at price of commodities, you're looking at the price of goods and services. So if you look at, say, the CPI index, which we use, about 40% of the CPI index is food and vegetables, right? Like that's food comprises about 40% of the index. So any change in food prices is automatically going to reflect in the change of price levels. Similarly, if we look at the US CPI, there are a lot of services that are also included into that particular basket. So when you see price levels move up, you kind of need to see which part of the price level basket is really moving up. So in India, for example, one of the reasons why our inflation numbers are coming down month on month is because the food inflation that we had last year and the year before is actually tapered down quite a bit, and you're seeing negative inflation or deflation in that particular basket, whereas other things may also be more expensive than they were before, but it's not going to show up because on aggregate that number is going down. This is one of the reasons why the RBI was a little hesitant to sort of cut interest rates in August, because they said that, we know that food inflation is contributing to this, but the rest of the inflation basket hasn't really moved down as much. And while there is some room to cut rates, we would rather wait and watch rather than act and then be left with limited options. And then we would look at, balance sheet expansion in terms of what the Fed has been doing. And you have seen more and more borrowings come in. You have seen the Fed trying to sort of unwind some of its balance sheet activities and bring a more consolidated and a more prudent approach to really managing their borrowings. So this brings us to de-dollarization. So I think here, this is a big word that I think gets thrown around a lot. And I mean, to be honest, I think it's going to be difficult for you to dethrone the dollar in a hurry. A lot of global trade does happen on the dollar. And while there are shifts that primarily got triggered by the Russia-Ukraine war, but also through all the trade negotiations that are running today, plus the kind of agreements and relationships that you're having between countries, I think it's still very early to call, the depth of the dollar. So politics and trade have contributed to a certain amount of deviation outside of the dollar, but I don't think it's really the end of the dollar era. And these kind of things take decades together to occur. So even if we're in the process of this kind of movement, it's going to take a long time for it to play out. We could also look at foreign exchange reserves as well as US macros and the dollar index itself to sort of look at where this is going, right? So if we're looking at trade and politics, like I mentioned, the big events have been US freezing Russia's assets during the Russia-Ukraine war, which actually led to a lot of central banks looking at safe options outside of the dollar. You also have trade, which is essentially about the relationships that you have between countries, which again has come under scrutiny because Trump has been talking a lot about tariffs, and he's been playing a very differentiated game. But even in the last era, right, like if we look at Trump's previous presidency, he was entering a trade war with China. And this trade war triggered a lot more bilateral agreements. You have seen Russia, Saudi Arabia, China sort of negotiate bilateral agreements with each other. You are seeing other countries also enter into trade with each other without the US as an intermediary. So these have been some triggers that we can look at, but these are all long-term things. It's not something that will happen overnight. If we look at foreign exchange reserves, there are two interesting charts that I would like to share with you. The first being in terms of how foreign central banks actually hold more gold than treasuries today. And this is the first time that you're seeing this kind of movement since 1996. So if you look at this chart, you see in 1995, roughly until, let's say, from 1970s to 1995, that is almost for like a 25-year period, gold predominantly was the asset class that most central banks had, right? Close to maybe anywhere between, say, 50 to 75% of their foreign exchange assets were in gold. And that steadily sort of declined from the 1980s. And this also coincides with, Nixon sort of abolishing the gold standard and saying that the dollar is not going to be pegged to the value of gold. So then you can see that this trigger in history has actually been, this event in history has actually been the trigger for this movement or this preference to own dollar assets over gold. And then I think gold assets declined almost to a low of, say, 10% of foreign reserves. And if you see today's values also, like I showed you the chart in the beginning, like even China's gold holdings are only about 5.5%. Right. So this is changing. And I think in this era, you can have, because your longer term yields on a lot of currencies, a lot of geographies have actually gone up. The dollar US treasuries may not be the number one contender in terms of bond options for central banks. That's something that we can look out for and see how that plays out. And this chart is also, the next chart is also very similar because it tells you, we just need to focus on the dark blue line, which tells you what is the USD share of foreign exchange reserves, right? So from being, say, 85, 90%, to sort of coming down to almost roughly 60%. So coming to US macros, this is where we want to look at fundamentals again. You are seeing unemployment pick up in a pretty serious way. And one important thing to know about unemployment numbers is that a lot of us tend to think that peak unemployment occurs when when we're starting the recession, right? But that's really not how it works. Unemployment picks up before your recession actually begins, and your peak coincides closer towards the end of the recession, because after that things start getting better. So when we're looking at these revisions to job data that we've been seeing through the year, I think that is a very serious indicator in terms of what's going on. You're not actually going to see peak unemployment and then say that, oh, the recession has started now. Instead, what's going to happen is you're going to see that unemployment has gradually been building up in the system, and that already is an early warning sign in terms of the labor market cooling. And this is something because the job revisions, right, like the data revisions have been as much or even higher than what happened in the 2009 crisis. So if we just take May, June, July data, they first cut out like 250,000 jobs. Then you had 1 month where you actually had contraction, meaning you had negative job gains. And then you've had a very disappointing month in August because your jobs data came in at 22,000 versus an estimate of 75,000, right? So clearly there is a big mismatch in what's going on in the labor market, which is why we need to pay more attention to that segment. And I think, of course, what's going to come out is, in a few days, the Fed is going to make some announcements, and they are going to share a summary of economic projections. And so far, the Fed has always been talking about how unemployment levels are not alarming. They're still at historically low levels because I think US unemployment has been in the range of 4.1 to 4.3% in the last year or so. It's really not crossed that threshold, and compared to like historic levels, it is a low level. But this time when the Fed is cutting rates, what we need to remember is that they're not cutting rates because inflation is under control, and that's pretty much the language they have been speaking since 2022, right? So inflation is still persistent, but it's just that the labor market has gotten much worse, and that requires more attention, and you're seeing firefighting occur there. You are also seeing a more sluggish growth. So if we look at the kind of projections that came out earlier last year, or the summary of economic projections from, say, your meetings in 2025, there's been a consistent downward revision in terms of growth. So I think last year the expectation was that the US economy would grow above 2%. Now you're closer to the range of 1.5%, and we're yet to see the next set of SEP numbers. And I think that will give us a lot more clarity on where growth numbers are showing up. And of course, everybody knows this, everyone's talking about it, but the US Treasury balance sheet is actually pretty bloated, and there is a need to shrink that balance sheet, make those assets more productive, and retire some of that debt. So now we'll also study some trends in terms of what's happening on the DXY. While it's very difficult to predict, let's say, how will the INR behave against the dollar, we can actually look at the dollar's inherent value. And I've taken two data sets here, which is essentially 2024 on its own versus 2025 year to date. And if we look at how returns have materialized in 2024, I think the dollar index actually appreciated, right? So it went up by almost 6%. You started the year around 102, 103 in that range, and you ended the year closer to 108 as your dollar index, right? Or 110. Similarly, I think your when you started out 2025, you started on a really strong note, and now you're actually below the 100 mark. You're closer to 97, 98 in terms of DXY value. So the dollar has been depreciating in terms of fundamental value to itself. We're not pegging it against another currency. And I think in this time, if you've been paying attention to these memes and all of that, I think last year there was a lot of talk about how if you were a US citizen, like traveling to Europe, your exchange rate is like 1:1, and the dollar depreciation has actually been something that has come to everybody's notice. Now, this is not a call on the dollar continuing to depreciate. It's not a call on, let's say, the rupee appreciating against the dollar. This is just factual data of what's going on with an index that measures the value of the dollar. So lastly, we're going to come into supply. So if we look at the supply dynamics of, say, gold, right? Like where do we get gold from? I think predominantly you're looking at mined gold. This is the main source. So almost 70% of silver is, 70% of gold is actually mined, and maybe about 30% of gold is recycled. So when we have this statistics in mind, like it kind of gives you some idea as to where gold has to come from and why it's limited supply in nature. So we'll also quickly sort of talk about the history of gold mining companies, because that could be another way to look at the precious metals theme. So when we look at gold miners per se, I think here the history has been pretty, it's been an interesting decade for that particular theme. So to start off with, I think back in 2005 to 2015, you had a lot of global gold miners go through a phase of leverage. Essentially, what they were doing is they were borrowing and then they were buying out and merging with other gold mining companies. So this essentially resulted in bad balance sheet health, because I'll show you some data later, but basically around 2012-13, you had a correction in gold prices. So then these companies essentially had a lot of debt on their balance sheet. They weren't able to be too profitable because gold prices corrected. And at the time that they invested in gold, like, this entire leveraging, capex, all of that happened after when you were at peak gold prices, right? So then that kind of took a while to correct. So you had this leveraging in 2005 to 15, then you had this deleveraging, which essentially went on from 2015 till about 2019. So from 2019 onwards, you could see some health return back into these balance sheets, essentially because they were able to deleverage, they were able to reduce the level of debt, and there was some strategic sort of merger activity, or like you had collaborative activity. So if you look at Newmont and Barrick, they bought a mine together in Nevada. So there was some kind of collaboration within the industry that showed that, okay, they're moving towards a better health. Then in 2021, 2022, you actually had a lot of free cash flow generation build up, right? But then, unfortunately, at this time, while these companies were becoming profitable and while they were throwing out cash, what also happened is that you had your inflation era, right? So wage inflation picked up. You had logistical bottlenecks, which also contributed to inflation. So then the cost of producing gold actually went up. So you didn't really see margin expansion occur in this phase, right? And then I think post this, you had you needed, so at this point, essentially gold prices needed to be at around $2,000 an ounce, and that wasn't really happening. So it was taking around $1,500, $1,600 to produce an ounce of gold. And at the same time, your dollar gold price was also trading in and around that price. So then it was very difficult to sort of really make money. Then you got into 2023, 2024, where this merger activity actually became more strategic in nature. So you saw consolidation within the industry, but it wasn't like the previous consolidation cycle where there was a lot of leverage and you saw buyouts and excess payment and stuff. So here your merger activity was a lot more strategic in nature. So you were looking at synergy. So you saw a merger between, say, Newmont and Newcrest, making it one of the largest gold mining companies in the world. And then this was, say, 2023 to 2024. But in this period, that is from 23 to 25, you actually see the gold price has taken off pretty well. So here and you no longer have that level of inflation. So then essentially your cost of producing gold is more stable, and your gold prices, that is your cost of realizing gold, is actually much higher. So then this has created a lot of profitability in terms of drivers for this theme. So now we'll quickly move on to silver and how can we understand this metal. So silver is a little bit different from gold, because when we look at the demand drivers, it's not just central banks and it's not just monetary conditions, but it's actually one of those metals that has industrial use, because silver essentially is a very good conductor of electricity, and it's not really the same. Right. And today, if we look at some of the big themes that are playing out in the world, you are looking at greener energy in investments, right? So whether you're looking at solar or whether you're looking at EVs, there is a need for silver in those products. So silver is used in photovoltaic cells. It's also used in EV batteries. You are also seeing a lot of investors look at silver as an alternative to gold, right? So that's another play there. And in terms of why are there silver supply and demand mismatches, and I think last 3 to 4 years, you have been seeing a deficit in the amount of silver that's there. Silver is typically not a metal that is mined. It is something that is recycled predominantly. So that's partly contributing to the deficit. You also even when silver is mined, it's not the primary metal. Like nobody mines for silver. What they do is that they mine for other metals like copper or gold, and silver just happens to be the byproduct of those mining activities. So then, like if I was to look at physical infrastructure and sort of generating silver, I need to go from discovery to production, right? And this takes a long time. It's not something that can happen overnight. So it takes about 7 to 10 years. So it has a long gestation period. And that is why this deficit also has a slightly structural nature to it. Yeah, so I think these are broadly what is contributing to the demand supply imbalance in silver. So lastly, we need to think about asset classes, not in their absolute terms, but in terms of what is the relative cost and what are the opportunities, right? So if we look at how gold is placed against treasuries, and this is an interesting chart from top-down charts, and they have a fantastic start that they publish on gold quite often. So you can go and look at some of their older data. Here, it's very clear that compared to treasuries, you're actually in a sweeter spot for gold. For compared to treasuries, gold is not in such a sweet spot, right? Because you can see that your valuation is significantly more expensive. And part of this is because treasury bonds have already reacted to the fact that jobs data is not looking good, inflation data is not looking good, the Fed has been a little bit late to cut rates, or has a very difficult sort of set of parameters to look at, right? So with respect to fixed income, I think gold is definitely more expensive. So there is a need for us to look beyond that. One of the reasons, and I'll show you a chart from silver versus gold, which is one way to sort of value an asset class like silver. And this is a little bit dated because this was published by DSP in their they have a monthly data pack called Netra, and that's also an interesting place to sort of identify or get data points. But this is essentially your gold to silver ratio, right? So how much do you, like, how many ounces of gold can you get for, how many ounces of silver can you get for 1 ounce of gold? And when you look at that, when silver has actually moved up since they published this chart in May earlier this year, but at that point, it was at a historical low, right? When it comes, your average gold to silver ratio is around 60. And if your gold to silver ratio is at around 100, then you definitely know that it is at some level of undervaluation. And when your gold to silver ratio can normalize in two ways, right? You can either see silver actually move up and then gain more value, or you can see gold come down. So as an investor, you need to sort of figure out which drivers are going to push prices in what level and take some valuation comfort in doing that. So lastly, we'll study the asset allocation quilt, and here I'm just going to focus on gold. And what I mean is, if you look at this era from 2013 to about 2016, 17, right, you actually make no returns in gold. There is, because you've had 3 years of consecutive negative returns. And even if you started a year earlier, and let's say you started with a 12% return in gold, after you had 2 great years of gold returns, even then you're kind of just breaking even at the end of that 4-year or 5-year period, which is not a great return for any investor to make. So this is why you need to be very price conscious about where you enter these themes and how that will kind of play out for you. We love looking at this quilt because it tells us a lot about asset classes and cycles. So what do we do at Sphere? We essentially simplify decisions for a lot of investors. We don't think that you should ever really worry about whether it's a good time to participate in markets, when you need to scale up investments, where you should invest, how much you should invest. So if you're the kind of person who's losing sleep over these kind of questions and decisions, then I think you could opt for a multi-asset product like Sphere, where we are able to take care of all of this for you and get you better returns that help you sleep well at night, that help you achieve the kind of targets you want to achieve in your personal and professional life. So what do? We are able to challenge your risk reward equation, which is essentially the idea that low risk assets and low risk investment should give you lower returns. And we're able to do this because we are very conscious about valuations, and that helps us protect downside returns as well as provide for upside returns. We're also contrarian in nature, so we're very early to these themes. So if you look at the precious metal theme, or if we look at even gold miners, we were very, very early to these themes. Right? It's not something that we started talking about in 2024 or 2025. We've been doing this for years together, even before that. And then, of course, we do multi-asset investing, which means it's always a good time to invest somewhere. And in terms of drawdown, this essentially shows how much do you lose in a product like Sphere. And if we look at the Nifty all-time high last year till its low, say in March this year, Sphere only lost about 10%, whereas the Nifty index lost about 16%. Our benchmark index is the multi-asset index that lost about 8% in this time frame. If we look at from Sphere all-time high, which is also the same time as the Nifty all-time high at that point, then again, we lost about 10.5% compared to the Nifty, which lost 12%, and the multi-asset index, which fared much better at 6%. Now, the multi-asset index has almost 40% in arbitrage, which is a non-directional call in markets at all. And it's fair to compare against both the multi-asset as well as a pure equity index like the Nifty, because we do have a significant allocation to stocks. So if we look at our equity allocation today is close to almost 65%. We have a good amount of allocation to both precious metals and global. And now I think debt is becoming one of our favorite asset classes. And you can see that we've been able to consistently outperform and beat the our benchmark, as well as even the Nifty, we've been able to outperform in the long run. So I think this is where we operate. We are somewhere between a conservative and a moderate portfolio. We would expect that, for a conservative product, maybe 10 to 12% or closer to 12% would be the compounding return that you should expect on a 5-year basis. As a SEBI registered PMS, our minimum investment is about 50 lakhs. We benchmark against NSE's multi-asset index. There is no exit load. We also have a fixed fee model. This leaves profits in the hand of investors rather than splitting that. And we would recommend that while there's no exit load, that somebody comes in with a 5 to 7 year perspective, because that's when you can truly experience multi-asset investing. We have a very flexible mandate that allows us to go 0 to 100% in any asset class or instrument. And with that, let's open up for Q&A, and I will leave our contact details here. So if anybody is interested in scheduling a one-on-one call, or if you have any feedback or questions, we can sort of take it offline as well. Please do feel free to write to us on WhatsApp at 9500027285. With that, I will begin answering questions. I do see one that's already in the chat. So the presentation will not be shared to any participants, but you can find our recording on YouTube, and it will be published over the weekend, so you'll be able to catch it